In this short video, we will discuss mark-to-market valuations and accounting. We will first define the practice of mark-to-market and then describe how it is used within the capital markets. We will also touch on the products that require mark-to-market valuations. We will then go on to discuss how to handle these types of transactions and use methods to offset some of the pitfalls in this type of accounting methodology. The concept of mark-to-market accounting and valuation was first developed amongst traders on futures exchanges in the late 1970s. It was not until the 80s that the practice spread to big banks and corporations from the traditional exchange trading pits. The concept is similar to that of unrealized gain, which uses the current market value of a product for accounting. Mark-to-market accounting assumes that an investor can exit a position at the current market rate and therefore should use that for accounting for that position. When an investor owns a position in an asset and it rises in price, the investor has an unrealized gain or a mark-to-market gain. And for accounting, that's the value that is designated in mark-to-market accounting. When an official accounting period crosses, which could be monthly in the case of an investment advisor or quarterly when it's a public corporation that announces earnings, the concept of mark-to-market faces its real tests. In a transparent futures market, such as the Chicago Mercantile Exchange, the exchange lists an official closing price or settlement price for each futures contract. The majority of hedge funds and financial institutions use this closing price to value securities and products they own. If the investor owns just the futures contract, then the mark-to-market value is the price. But more opaque products in portfolios, a manager will use inputs including the price to value those specific products. Within the world of finance, there are many types of products that are traded within the over-the-counter market. These products are customized where trades are transacted directly through market participants. Over-the-counter trades can be cleared directly through the participants or through an exchange. Over-the-counter products can be as simple as an exchange-traded product or as complex as an exotic option that uses a number of assumptions to generate a value. When an opaque product is traded, the transaction price is the market value. But as each day passes, the change in different inputs such as price, interest rates, and implied volatility could change the mark-to-market price. For an institution or hedge fund to confirm a valuation of a product, they will usually ask a third party to generate a valuation. This could be another broker or an independent valuation company. For opaque products, finding a firm bid for the product or an offer is not very realistic. With this in mind, portfolio and risk managers need to create some type of reserve that can offset the increase in mark-to-market value, as the liquidity risk of an opaque product can hide losses generated by attempting to exit an opaque product when markets move in an adverse direction. There are two categories of reserves that can be used in mark-to-market accounting to offset the opaque quality of the transactions in certain types of financial instruments. Market risk reserves and credit reserves are funds placed aside to account for slippage when a transaction actually takes place. Market risk reserves can be calculated by examining the bid-offer spread for a given product, taking into account the size of the position held. For example, on a 10-year natural gas put, there will be few liquid bid offers, and it will need to likely have a large bid-offer spread that is worked through the broker market. A trader that owns this position will need to have a market risk reserve that incorporates the spread a market maker would charge to exit the position. A credit risk reserve focuses on the credit of the counterparty in which the deal is transacted. Credit risk can be offset with credit default swaps, but this only works for larger, more established companies. Funds and small banks are unlikely to have available credit default swaps in their name. A credit risk reserve is the process of creating a synthetic credit default swap. The process of mark-to-market accounting is complex and dynamic, but it has many logical tools that can be used to mitigate the risks associated with this type of practice.